and our topic for today is how to select profitable stocks in the stock market. अब स्टॉक मार्केट में इन्वेस्ट हर कोई करना चाहता है और अपने प्रॉफिट्स भी हर कोई मैक्सिमाइज करना चाहता है, बट the art and science behind choosing the right and profitable stocks is something that is very important and something that we must understand. To enlighten us about that, we have Mr. Maneesh Nath over here. He is an award-winning investment portfolio manager. He did his masters in engineering from the University of Cincinnati, and he has more than 20 years of experience in investment management in Indian, US and European stock markets. So let's welcome Mr. Maneesh ji. And I would request Mr. Ankush Arora to take the session forward.
Hi everybody. Welcome Maneesh ji. We have Maneesh Nath, a very humble personality from the stock market. Right. Talking about humble, the topic we are going to discuss today, one of the exchanges, Bombay Stock Exchange, it started in around 145 years back under a banyan tree. So talking about a humble beginning, that's about it. So would just like the entire session, because the audience is just handful, we would like to answer and address the queries because you have taken time, time out to come here today, and we would like to ensure that your questions and your queries, everything gets addressed, right? So with that said, should we start by a very simple question? What is stock market?
Yeah, so thanks a lot. First of all, stock market is a very, very broad subject actually. Over here we are going to kind of discuss in brief or for everyone to kind of understand. And stock market is when a company get listed in the market, it comes from the primary markets to the secondary market. So at the time of IPO, basically you are going from unlisted to a listed domain. So when a company comes from private to this public market, it comes into the arena of the stock market, which is more of an ocean, you can understand, where all the private companies or your startups or any company which kind of starts from the humble beginnings, they actually come into the stock market down the line at some point of time in their life. And the stock market basically is a $100 trillion kind of market cap in the entire US, India, and European and Chinese companies. So all the big companies, they are mainly listed, and investors can access to the financial data and have an understanding that whether it's a good company or a bad company, and then based on that they will find good companies, and they have an option to invest in these companies. So they can sit in a remote town in Brazil and they can invest into an Indian companies, whereas and similarly someone sitting in India can have an access to a company in the US. So that's what the beauty of the stock market is.
Right, fantastic. So if I can understand that correctly, stock market happens to be one of those alternate asset class where you can multiply your investment, though there are risks. Yeah, would you like to say something on that?
Yeah, so stock market, we obviously have some risk in the companies where the management is not good, where they don't have a clear business model, they have no idea on like how to kind of scale up, and they don't have the pedigree or the experience to navigate a company through like thick and thin. So obviously there is some risk involved, but on the other hand, we have some companies like Facebook, you are seeing like today in the terms of they started from a Harvard dorm, and just look at the kind of market cap they are claiming right now. And the same with kind of Tesla, with Google, they all started in a dorm, in a small garage, as they kind of call in the Silicon Valley. Even in India also, you have some experience that okay, these companies, they started with a very, very simple kind of foundation in the beginning, and from there they kind of went from a stage of, let's say, $1 million market cap to, let's say, $1 billion, and in some cases even $100 billion kind of market cap. Even I'm talking about Indian companies, I'm not talking about the US. Over there the range is even from 1 million to, let's say, even $1 trillion also. So it's a huge market, and everyone should kind of participate in these kind of things.
Okay, thank you so much for that. We have been hearing this one catchy phrase and a catchy word, multi-bagger. What do we mean by that?
Yeah, so multi-bagger stocks are the stocks which grows from, let's say in the Indian context, it's trading at 1,000 crore kind of market cap, and the company has the potential to go 100x from there. So that we will term as a multi-bagger. So to kind of give you an example, when I came to India in 2011, I found a company called Astral Pipes. It was trading around at 350 kind of CR market cap, and in the initial 3-4 years it went a 10x fold, from 350 CR to, let's say, 3500 CR, from 11 till 14 to 2011 till 2014, and from there on in the next 7 years one more 10x. So these companies which can keep on compounding, which can become like 10x and then one more 10x in the span of 10 in a decade, they are called multi-bagger stocks. So they are like the wealth creators and real basically kind of blessing if you have some of them in your portfolio. They take care of your entire growth of your wealth, and they take care of the companies which are not performing well. In some cases even they are kind of going down. So one multi-bagger can offset a couple of these negative companies as well. So
Okay. Now, interestingly, that sounds like a gold mine, right? And as you rightly say, the gold mine, there is always a risk. And I'm sure that, there are certain ways where you can mitigate the risk in this space as well. So would you like to share some light on the hedging aspect of it?
I will say that even before that, like the hedging will come down the line actually, like once we have created the portfolio. Even before that, on how to kind of find these multi-baggers, I think is one thing which people are obviously kind of interested in. And how to find multi-baggers is basically that I have created a framework over the last 2 decades of experience, some on Wall Street and then over here in Dalal Street. So what happens is that the companies which are in the at 1000 CR kind of market cap range, almost in India there are, let's say, from 200 CR to 2000 CR. There are companies, almost 1000 companies in this kind of market cap band, and there are some kind of issues over there in terms of their valuation, where the valuation is very high, and so we cannot remove them. And then there are some companies which have very low profit margin, very they are not showing any growth, so we cannot remove them. So we are looking for what exactly we are kind of looking for. We are looking for companies which can go from let's say 300 crore market cap to 30,000. So they have to be like the best of the best. So in terms of their sales growth, in terms of their price growth over the past 5 to 10 years of their financial data, we have to find out, okay, that these are the top contenders, and they should not be overly priced at that particular point of time. If the valuations are already, like, let's say PE level of 100 has been kind of achieved, then the chances are that the stock will not be a multi-bagger. So over there you have the risk of actually losing money instead of making money. So a good company can be a very bad stock, and vice versa. But let's say we are focused on multi-baggers, and then from 1000 companies we will narrow it down based on the valuation part, on the profit growth and sales growth, and companies which have lot of debt, we will remove all those companies, and companies which are not growing or not showing any profit, we will remove all of those companies, and we are, let's say, left with 200 companies. So we will go to their website, and we will look at their annual letters, what the management is saying, how they plan to execute their like future capacity expansion plans, and based on that we will find that, okay, these are the companies where we understand their kind of business model, and we are able to forecast that, okay, these companies can grow based on the past 5 to 10 years of their financial data. We have some idea that, okay, in the next 3 to 5 years they can be at this level, and once we have sales growth, profit growth, the valuation obviously follows. That market cap will move from 350 CR to like 3500 CR in the case of Astral, and similarly. And so once we have created this framework, and we have kind of found the top 20 stocks, then we create an equally weighted portfolio. So What I mean by that is, let's say we are investing $100,000, and so five companies, like 5% is there in the top 20 of those multi-baggers, and so like $5,000 per company for like 20 of them. So we have equally weighted and allocated our entire portfolio. And out of that, if two of those companies become 100x in a decade, our portfolio kind of becomes 10x. So that's the maths behind it, and we have not even discussed on what happens to the remaining 18 stocks. So that's the power of the multi-bagger. So that's why we are kind of talking about that. Now coming to your hedging part. So hedging happens when the markets are kind of going up, then everyone is making money. All your good stocks are kind of doing well and all that. So that's a very rosy picture. Sometimes some unexpected turns happens in the market, and the market correction happens, let's say of 30%. In that case, your portfolio, irrespective of how many multi-baggers are there, the portfolio will also show some temporary losses. So what hedging does is that you are long on good quality stocks and you are short on bad traits of stocks. Like let's say that the company is very overvalued, there is no growth, there is a lot of debt, and you are predicting that okay, the stock of this company will go down. So you are shorting those stocks. So that's how you will hedge. You will make money on the long side, and you will also make money when the stock is going down. So in a correction, these bad companies will go down even more, and that's how you cannot do the hedging. And hedging happens while shorting the stocks as well as shorting the index also. So there are several techniques for that, but this is like on a broader context.
So great, thank you for that. We have seen a lot of changes, dynamic changes post 2020. I will not talk about all the worst ones, but let's say all the good ones in terms of the tech space. Industry has revolutionized, sectorial companies are performing. We've been learning a lot about generative intelligence, cognitive intelligence. There are a lot many artificial intelligence companies which are popping up like mushrooms, 5 a day at least. How do you see Indian industry, going forward in a decade with regard to the stock market?
Yeah, so basically you have to be in your circle of competence. That's very important. In investing, it's not that you should be able to get multi-baggers in any industry, in all the industries. If you have niche in or experience in particular industries, even 5 industries, I think it's more than enough. So you don't have to go in predict in the latest hot thing kind of going on in the market. Let's say the AI thing is going on, but it's very hard to predict on how the stock is going to behave, or how the company is going to create cash flows 3 years, 5 years, 10 years down the line. So more tough it is for us to understand that okay, we are not able to kind of get the coupon on that particular company, that okay, that how much we are going to get after 3 to 5 years. So then it's very hard to value them. Whereas in a company, let's say in the case of Coca-Cola, or like in any where there is human nature involved in that particular in the consumption of that particular thing, what happens is that there is a thing going on. Let's say people are drinking Coca-Cola on a daily basis, and you know that okay, this many have these many cans get sold on a daily basis over the last 5 to 10 years, and this is there where the company is expecting the future growth rate. So that is very predictable compared to coming to the AI thing where the company has popped up yesterday and it's going to go bust in the next couple of years. We don't know. So we can't with very high certainty kind of bet on those companies. So that's a problem with that one. But as I said, if you have 3-4 industries where you have experience and you are investing, there are enough companies, there are hundreds of companies. You can just find the top 5, 10, 15 companies, and that's enough for your portfolio. You don't have to be knowledgeable in all the industries. And in a country like India, I think India is a place where there is a lot of growth happening, going to take place in the next few decades, where you will make a lot of money and the companies will also will do extremely well.
Thank you. I have one last question, and then we'll open the round to the public. So having talked about international markets, international companies, of course, as you mentioned, Facebook, Amazon, they just started from a garage and now see where they are. They're very well listed, and the fluctuation of the stocks, in fact, are commanding the markets in some way or the other. How do you see, let's say I put India, America and China, How do you see, where is the long-term investment purview as per you?
Yeah, so for institutional investors, it's very important that they have a diversified portfolio. When I say diversified, I'm talking about in terms of geography. So they have investment in the US, in the European region, in the Asian region. So, but for a retail investor in India, I think they have lot going on within their own country, and they should not think on that. But if someone wants to take a bet on the US company or anything, that's it's a good way to kind of make or kind of diversify your portfolio. But given the fact that India will be growing at a much rapid rate, and there are companies or IPOs coming on a daily basis, as you are saying, in this country, so I think diversification is okay. But for small retail investors, I think they are kind of well taken care of within the Indian system as well. But for institutional investor, it offers a very broader market. As I said, it's like a $45 trillion market in the US, and India is like only $3.5 trillion kind of market. So it's a huge opportunity waiting over there. But it's for mainly for big investors like family offices and ultra HNIs, and for the people who are into like institutions, they have to have a global diversification basically. So for them, they should look into the global markets. Let's say US, European, and Chinese market are also are equally good. But as I said, it depends on the appetite, on how much they can invest basically. But for retail investors in India, I think India offers a great place.
Right. Thank you so much, Mr. Nath. Thank you so much for addressing all of those fast questions. Now it's open to the audience.
So, what is your process of actually selecting or going for the multi-bagger stocks if I talk about? Like, do you have any indicators in that, or you have some technical indicators as well? Like, how do you filter the multi-bagger stocks in today's time if I talk about?
Okay, so multi-bagger stocks, as I said, let's say we are kind of looking for a 100x basically, like starting today. So the market cap should be around 1000 crore, and in that neighborhood, let's say we kind of put a filter for market cap in between 200 CR to let's say 2000 CR. So we get around 1000 companies in that range, in that market cap range, in the current system. And I'm talking about Indian markets. I'm not talking about like the global markets. Global markets is even kind of numbers are even higher. So, but let's say we are kind of looking at thousands companies. So we will remove the companies with a PE level of, I'm just kind of giving you an example. Let's say PE level of 75. We are not interested in that, because the already whatever the appreciation has to happen has already done. So then it becomes very risky stocks actually. After PE level of 65, 75, it becomes on a higher range. Risk level goes up very lot. Then we remove so basically we will remove higher valuation stocks, we will remove the stocks with higher debt, we will remove the stocks where we are not seeing any growth or or we are seeing any kind of negative corporate governance issue or some management problem going on. So let's say we are left out of this filtering, we are from 1000, we come down to 200 stocks. So from that 200, then we will go individually and look at the websites of 200 companies, read the annual reports of 200 companies, they understand their business model, or try to understand whether this is our cup of tea or not. So not every company we can go and understand, right? So, and we don't have to understand all of them. As I said, you should be focused in your domain basically. That okay, that you have some experience in the pharma business, let's say, from your own life. Then you should focus on those companies where you are seeing that okay, like Cipla is doing well, or this particular company is doing well. So basically in your circle of competence, you stay with that, and then from that 200 you will find the top 20. So what actually happens in those 20 companies, I will kind of give you a highlight on what kind of characteristics they kind of look like basically. So they have a PE level of around 25, they have a return on equity of more than 25%, they have a return on capital employed of more than 25%, they have a profit margin of more than 15-20%, and it's a consistent profit growth basically. And then you are seeing sales growth of more than 25%, and even your profit growth is also in that range. So these are the broader level this thing, but obviously it requires a lot of experience, lot of data handling and reading, and it comes with experience. So I think I answered the question.
So small caps and mid caps is what you target, or?
Only the micro caps actually. I have for retail investor, I will not recommend to kind of go. It's basically going to the ocean floor and then kind of picking up the gems from there. But the pressure is very high at those levels. So for everyone, they should be in the mid cap, small cap range. They should not go below 5,000 CR market cap. You have like treat CR as a meter basically. So like in the ocean diving you are doing. So it requires a lot of expertise, and even I started in that same way. So it's not that from day one I'm doing this, I'm an expert. It took me like 2 decades to kind of get to at like 100 CR level, that I can just figure out very very quickly that okay, whether this will be a good company or not. But there is a lot of experience, lot of both good and bad, and you learn from your good companies, and you try to remove and try to have a close feedback loop where you are learning from your good companies and you are removing the quality or removing the negative parts from the bad experiences you are having. So let's say in a company where there is a client concentration risk and only one customer is there, and if that customer leaves, then the entire company collapses. So that you understand down the line that okay, that you have to have a diversified portfolio. So these are the some negatives and some positives. Like in the case of Astral, they kept on increasing the capacity. They were very good in kind of managing that, and they were able to kind of find and they were able to kind of distribute it also. Like the distribution channel is also very important. If you are just good in kind of building the product and you are not good in selling and distributing, then the product will not sell eventually, and you will not be able to kind of increase your capacity. So the product should be kind of sellable first of all, and the management should be smart enough to allocate the capital wisely and increase the capacity, as well as take it to a level where they can be an India level product or a global level product rather than just a small region based product. That company is never going to grow big. It will reach only like 5,000 CR kind of level, never like 50,000 or like forget about the 5 lakh. So these are like some of the things.
So for someone who's a novice like me, right, who wants to enter into understanding how to invest in stocks, okay, I may talk to you otherwise, but generally, let's say if I have to look at a screen and understand where I'm investing, one of the advice that everybody gives, or the usual advice that most people give, is look around you. So look at, let's say, Hindustan Unilever, or look at like an ITC and stuff like that, or the Tatas or whatever. They have a certain kind of stability, right? And these are things that will always exist, and so the pattern of growth is going to be consistent, and they are less risky. Now, I don't understand anything of it. Let's suppose I am a novice. How then do I identify the stocks and how much to buy? Of course, I know you would say कि सबके spending capacity अलग होती है. But let's say I start with 1 lakh. Right? I say that okay, I have 1 lakh and this is how I'm going to start investing, and whatever profit I'm going to make, I'm going to reinvesting from that. Okay? And my day one begins on, let's say, the 1st of August 23. What advice do you have for me? How should I look at it? What is the background check of the study that I need to do in simple terms to be able to at least start investing?
Yeah, so I think everyone should invest, and you will have good experience, bad experience both. And as I said, you start learning from the companies where you are actually making some money, and try to remove the
How do I identify those?
You start with as
What do I see? What are some of the top 3 markers or top 5 markers?
you
Identify those?
I think I kind of highlighted on that when I said like price to earning should be around 25. That's a good marker basically to kind of begin with, because compared to companies where you are investing with a PE level of 75, then that's a problem. Basically, you already like the price valuation is kind of caught up basically. So price to earning can be like around 25. Then your profit growth and sales growth should be more than 25%. So I'm just giving you like the broader, then doesn't mean that this will be a multi-bagger, but debt to equity should be less than 0.5, and as less leverage possible. So that's like the 3-4 things. Return on equity, return on capital employed should be more than 25%. So these are like the basic, but if we go on deep, then there are obviously many other things. Your profit margin, money control is a very very good, very comprehensive website which you can Yeah, but it will you have to have some experience, as I said. And if you are like still struggling, then you take some help. And you watch news, this CNBC and any news you can catch hold of. Try to actually don't confuse the financial part and the stock market. I can understand. Even I was there in the same place 20 years ago, so I completely understand. But you have to understand that all you have to do is like if you want a shortcut, basically the shortcut is that you stick with 5-10 companies and you just let it roll, basically. Don't get confused. Don't second guess yourself. Obviously make a framework over a period of time. So let's say every 6 months, 1 year, you monitor. Don't monitor the stocks on a daily basis unless you are into trading, unless you are like full-time trading. If you are in investing, you invest in 5-10 decent companies, and then you see that okay, how they are performing, and then try to understand why they are performing in that particular way. So let's say if a stock is going up, then you try to understand why it's going up. If the stock is going down, then you will have some negative news, basically something going on that okay, management, some CFO resigned or something like that, some corporate governance issue, or they are not able to get the funding, or whatever that reason is. So over a period of time, you will have that understanding that okay, nothing happens in a day or in a quarter or in a 6-month period. It takes time. So value doesn't get added on a daily basis. Like it happens, but the valuation doesn't catch up on a daily basis. So what changes is the price or like the perception on a daily basis. But long-term wealth creation, especially from the multi-bagger point of view, happens over a period of time. Let's say we are talking about 3 to 5 years. So that's the time frame you should have, and that is why watching the portfolio on a daily basis doesn't help.
Just wanted to understand what is your, you are into portfolio management services or you are into advisory. How can you be, how we can take advantage of your knowledge?
Yeah, I have a blog. I have some articles and some video sessions like this one, so which we can talk about it later on.
You said that we can purchase stocks from US and European countries. So what is the medium how we can purchase?
So there are some banks who are offering, like HDFC. HDFC
I have a trading account with Zerodha. So can we, is Zerodha offering?
Eventually they will, and right now there is something going on in Ahmedabad, in Gandhinagar, in the Gift City. So we have to see on how that is also coming up.
One more question. Suppose if I had purchased a share 1 year back and today it is giving me return up to 30 or 50%. Should I get out of it or should I remain in that stock?
Yeah, actually that's a very good question. Actually everyone faces that. It's very hard to keep, but I have to convey one point over here, that there are, out of 5,000 companies, there are only 50 wealth creators. So the only top 1%.
I have 14 shares in my portfolio except for one LIC. Because of the recent market has gone up, only one share is in loss. So mostly there are 3-4 shares which are above 30%. So I wanted to invest for long term. But I just wanted to understand, in 1 year if the share is giving me 30 to 50% return, should I?
I can just tell you that Buffett bought Coca-Cola stock in 1987. He started buying into it. Until date, he has not sold. So as I said, there are only 50 multi-baggers in a country like India. So if you have one of them, the selling will be the biggest mistake which you can do. So you have to see whether this company can still grow. If yes, if there is no reason to sell, then there is a reinvestment risk also in all these companies when you are buying and selling. That okay, let's say you have doubled your money in a particular stock, and now where do you reinvest, in which company? Let's say that company is goes down and this company becomes a multi-bagger, so that's a risk. So you have to have that kind of understanding that okay, whether, but like I can tell you, like 30% gains is nothing basically. We are looking at 3,000% kind of gains, and we are still holding in some cases. But that requires a different mindset and different game. So, but I understand.
I with the long term, say 3 to 5 year horizon. But sometimes you feel after 1 or 2 months, you check the portfolio, you see that some shares are at 30-35% annual return. So I just wanted to check.
One take this. But actually it depends if you're investing in sectoral also ना, जैसे आपको कोई sectoral है या consumer वाले या तो ऐसे होते हैं तो stocks की that is going to give you good returns, but जो sectoral होता है like steel वाला कर रहे हो वो करो, that depends कि cycle पे भी होता है, like you would be able to tell better.
But that's
But
true,
that
अगर
also
आपको
depends.
30% 40% रिटर्न मिलता है then you want कि उसमें से थोड़ा सा निकाल के किसी और शेयर में अगर लगाए या something like that.
Yeah, that will come in like short term investment. उसको हम बहुत मतलब we will not go with the 3-4 years kind of investment time frame. So if you are looking for 1 year, that's a very short term in our perspective. But everyone has a different time horizon and different skill set. It's like this is a game where at certain level everyone has the intellect. It's more on the temperamental part, whether you are able to sustain in those kind of, whether you can keep those gains with you and still have the vision where the company will be in the next 5 to 10 years. I know so many people who have invested in Infosys 20-30 years ago, and they are still holding it, and they are big fans, and I tell them that like nothing is going to happen in this particular stock because of this reason. The market cap has already gone up, but they are okay with that. So they are like sitting on thousands of percent of gains, and they are still holding it. So 30% basically you can understand that it's nothing basically compared. So you should have a very long time frame. So I think he has a question from me.
So I think what you're trying to say is that unless you don't need the money, you shouldn't sell. Right.
So I just want to thank you for the session. It was quite informative, and you've cleared one of my, very aajkal there's a bandwagon going on. Everybody is wanting to invest into AI. So I was also looking out to invest in AI and what company to choose from. I already have a strong portfolio around 59 stocks. So, but I was already looking to diversify into the AI portfolio. Now you've cleared with your vision and with your knowledge, you've cleared that at least we shouldn't be jumping onto the bandwagon of investing into every domain possible. So if AI is not my cup of tea, then maybe I should hold myself back, not go into AI and concentrate on the other portfolios that I have, like the pharma or the auto sector for that instance. Be focused on that itself and not go and invest in AI. So thank you for that.
As per the Indian market scenario, what will you suggest? What are the sectors to look for the initial investors, like who have recently started investing in stock market?
I will say consumer durables, because they are seeing that in their house or in their offices. So automotive, pharma, these are like some of the sectors which you are seeing on daily basis.